We are going to start with our stocks for a crash series. So Koshi's been asking his guests, our guests, if there was a significant pullback. We're not talking a 5% correction. We're talking, a big sell-off. What company do you have your eye on that you would like to pick some up on the cheap? Claude, can I start with you?
Of course. So, given the question, I had a few things in mind. First of all, when I'm buying something during a crash, if everything's going down, I want to buy something that I have a lot of confidence in. The reason for that is when shares are crashing, I get scared and I get hesitant to buy. So that's why this kind of exercise is very useful, because if I've said previously, hey, I want to buy this when it's down, I'm more likely to actually go through with it when the opportunity arises. So what I chose, and then the second factor is I want something that will go down in a crash, right? So the stock that I chose is a company that I do own a tiny amount of shares in called Australian Ethical Investments. I'm sure anybody around my age watching this definitely knows what this company is. It's been on your Facebook feed for the last 3 years. You probably can't avoid it if you're interested in investing. And that really is why it's a high quality company, because what is so cool about Australian Ethical Investments is its main important growing client base are millennials, not Gen Z, not boomers, millennials. And this is a key time to have millennials as superannuation clients. So they're fund manager, super fund, right? And so basically millennials are reaching that point of their career where they're putting more into super. They're earning higher salaries now, and that's probably going to continue to go up for the next few years on average. But they're also still a really long time away from taking their super out. So it has a really good setup there, and those people are going to keep on putting their money into the fund over time. And so that's great. Look, there's also the fact, and I think we'll talk about this a bit, but fund managers, they're not software companies. They're not amazing business models, but they are quite good, because if you're managing $1 billion, you can probably expand that to $2 billion without really growing the investment team very much at all. The regulatory stuff, the legal, it's all sort of a fixed base almost, so they can scale very well. Of course, then you've got the tailwind that these guys have a very strong brand in ethical investing, which itself is on a bit of a growth trajectory. It's there are certain people that sort of really against ESG investing. They think it's stupid or whatever, but they're gradually losing the argument, even though coal stocks are up, once every 5 years they have to crow about it. But the fact is that the long term, coal stocks are down, right? And ESG investors are doing better. So it depends. Yeah, maybe ESG looks stupid in little periods, but in the long term, it's winning and it should attract more money. And I think we're going to keep seeing that. So it really ticks all the boxes. Only problem, this is trading on 110 times earnings, which even for all of the good qualities I've described seems maybe a bit too much. It wasn't long ago it was half that. So because fund managers are leveraged to the market, when the overall market goes down, their fees will go down as well. So one would hope that Australian Ethical Investments share price hits really hard in a crash, and that's when I want to be buying.
Okay, got it. Thank you. AEF is the ticker code for Australian Ethical. For a crash, Rudi, what would you have on your list?
Well, I feel a little bit sad now, because in subsequent to Claude's reasoning, I should have picked Macquarie, because for all those people who doubt that ESG investing will have a benefit, today Morgan Stanley has increased its price target for Macquarie to $240, and that is because Macquarie is the vanguard in Australia, globally, one might say, as an asset manager in green energy, in ESG, in sustainability, etc., etc., etc. But I didn't pick Macquarie, but I would buy Macquarie, by the way, if it pulls back heavily. I picked ResMed, and I picked ResMed for similar reasons as just mentioned by Claude. I am very confident that it is a very long-term, very rewarding exposure. It has trends that support its business model. It is linked, which is to the credit of management. It is linked now to telehealth, which basically means that healthcare is moving out of the hospitals into people's homes. And just as a side remark, over the past 10 years, mind you, the share price has appreciated by more than 1,100%, which gives you a little bit of an idea of how well those shares have performed. And that is a reflection of how well this business, which is not the same as a share price, but how well this business is being run, positioned, and has performed.
ResMed.
I would, to be honest, I would buy it here.
Well, that's what I was.
Has,
you stole the words out of my mouth.
Yes,
I mean, do you
it
need
has
to
already
wait for a
pulled
crash?
back. No, it has already pulled back from $40. I think it's a $40 plus stock, in particular if you give it more time than the next year or so. So it's already a buy here.
All right. So ResMed, and I'm going to throw Macquarie in there as well, just because.
Yeah.
Rudy. Yeah. Okay.
I
Good
would-
one.
I thought that was
yes.
a good idea too. Remind me to actually do that in a crash. By a bit of Australian ethical,
Yes,
maybe. If you
exactly.
Can we
Let's-
all remind each other, because I
Yes,
suffer
that-
from
Yeah, we
hindsight.
all remind each other when Macquarie sells off, we should buy.
Yeah, okay, good. Deal. Done.